First is investor DNA is about understanding the psychological and behavioral traits that define investor success. From your experience, what have you found about that?
Very difficult to answer it in short. I mean, I can teach a whole 3-term course on this, on the biases that entrap us. But the most, I mean, there are a whole list of biases. Like, for example, आपको किसी भी position में loss book करना अच्छा नहीं लगता. That's a loss aversion bias. One of the biases which is very hard coded with us, into us, is storification. So human beings are storytellers. They respond to stories, they learn through stories. Stories stick in our mind much more than data does. But stories are a trap as far as investing is concerned.
So fear and greed, it's important that wealth managers can definitely strike a balance between fear and greed and help the clients to make more rational decisions. There are 5 steps to it. So educate the client, on the behavioral biases. Fear can obviously lead the client to, make short-term withdrawals, looking at fluctuations, untimely withdrawals also. While greed can, a lot of time direct the client towards, chasing unsustainable returns. So important, to educate them that we need to have a understanding of the behavioral bias. Then in wealth management, we follow, proper personalized financial planning.
So I want my panelists to give a one word to the question that I'm throwing, and we are all very excited. It's a very simple thing just to build up the momentum for this powerful, panel discussion. The one skill every wealth manager must have. Any of the panelists can take it, please.
One word. Data orientation, ma'am, says Devina Mehra.
Okay. Data orientation. Please note. Anyone, any different answer? Any other panelists?
Client
would like to add?
centricity. Patience.
Patience. I think there are very interesting words coming up, so I think everyone should give one word, please.
Fear.
Fear.
Fear. Oh, great.
I'll go with what Nimish said, perseverance. I think that is very
Perseverance.
important.
Great.
All right.
Learn and learn.
Great.
And then earn.
So I think now you know that you should have all of these. The next question, your go-to investment strategy in one word. Go-to investment strategy in one word.
Nothing lasts forever.
Great.
Nothing lasts forever.
Great.
Opportunities so adversities.
Adversity, okay?
Yeah.
Agility.
Create alpha.
Create alpha.
Be consistent.
Be
Consistency,
consistent.
okay?
Keep it simple.
Keep it simple.
Keep it simple. So I request all of you to learn these tricks and tips of the trade, their investment strategy that the dear panelists have given. What's the key to successful product innovation?
Deep thinking and customer orientation.
Keep thinking and customer orientation.
Yeah.
All right. Any other?
Catching the pulse. I think that's very important.
I think
Achin
wonderful.
would have some.
Okay. So last, one word that defines client relationships.
Trust. Okay. Family. Okay.
I think this is one I asked in the last because I think most of us will agree. We have been talking throughout the presentation, trust. So a big round of applause to all the panelists, and we are all excited and geared up for the panel discussions. Thank you. Over to you, Deepak sir.
So thank you, Rimple. So we start this session panel discussion, and as you see, we have so good speakers, so good panelists. I am sure we'll be able to do justice to this topic. Topic is understanding investor DNA. तो हम वो दिमाग के लोचे की बात कर रहे हैं यहाँ, right? That mental shortcuts or behavioral finance, as you saw. So we'll try to decode that for you. And I'll start with the first question to Devina ma'am. First is investor DNA is about understanding the psychological and behavioral traits that define investor success. From your experience, what have you found about that?
Very difficult to answer it in short. I mean, I can teach a whole three-term course on this, on the biases that entrap us. But the most, I mean, there are a whole list of biases. Like, for example, आपको किसी भी position में loss book करना अच्छा नहीं लगता. That's a loss aversion bias. One of the biases which is very hard coded with us into us is storification. So human beings are storytellers. They respond to stories. They learn through stories. Stories stick in our mind much more than data does. But stories are a trap as far as investing is concerned. I mean, लोग आके आपको बहुत अच्छी अच्छी कहानियां सुनाएंगे कि this company has this great story, management is great, this is going to be the trajectory of growth for the next 20 years. Every research report you pick up is a story showing growth in earnings every year. Now, let me tell you how many companies have been able to show some growth. I'm not even saying 5% growth, 10% growth, growth greater than zero every year for 20 years. Any guesses on how many companies have been able to tell you, have been able to do that? 4,500 companies listed in India for that period, approximately. There's precisely one company which has done that. आप research report पढ़ोगे तो 99% of the companies will grow every year. So that's the difference between data and stories. So, and it's very hard for human beings to get over biases. That's the key insight I want to give you, because it is very hard coded into us. आप optical illusions देखते हैं, ये दो चीज अलग अलग साइज की नजर आ रही हैं, नापो तो एक साइज की है, right? But if you really, even after you intellectually understood it, your eye will still see it as two different sizes, because that's the way the brain is molded. I always say your brain is out to sabotage your portfolio, because it has no interest in your portfolio. The evolution was concerned only with two things: survival and procreation. And that's the way we operate. So loss aversion was a very good thing. कि अगर आपको झाड़ी में कुछ नजर आया, when you were a hunter gatherer, even if it was not a tiger, it was good to run away. But now that doesn't serve you. So it is, you have to understand biases, but even after understanding the biases, it's very hard to get rid of them. But at the very least, have a data orientation, look at the data, don't listen to stories, because market A is not interested in stories. B, if you tell a story often enough, you begin to believe it. So I have seen this even with fund managers, the people who go and say, this is a high conviction name, I love this management. They will never be able to change their mind even when the data changes. So whenever someone asks me, what are your high conviction ideas? I said, high conviction is another way of saying great story. I have a lot of emotion invested in this stock. So do not invest emotions in anything that you buy. It has only one purpose: to make wealth for you. Emotions are for family and friends, not for the portfolio.
Great, great. So my next question is to Mr. Inderbir. Fear and greed are often cited as dominant emotions, right?
Yeah.
How can wealth managers help clients strike a balance between fear and greed?
Okay. Very warm good afternoon to all. Our industry is full of disclaimers, so I'll give a disclaimer first here too, that whatever points I'm going to state are for general clients. It may differentiate depending on the client profile. Sometimes, we have segmentations in clients, so there are different strategies for them. But the points I'm trying to put forward is going to be very general. Okay. So fear and greed, it's important that wealth managers can definitely strike a balance between fear and greed and help the clients to make more rational decisions. There are 5 steps to it. So educate the client, on the behavioral biases. Fear can obviously lead the client to, make short-term withdrawals, looking at fluctuations, untimely withdrawals also. While greed can, a lot of time direct the client towards, chasing unsustainable returns. So important, to educate them that we need to have a understanding of the behavioral bias. Then in wealth management, we follow, proper personalized financial planning. The reason we create, achievable long-term goals is so that, we get into a process and we track them and we monitor them so that and the goals have to be, and the planning has to be aligned to the client's risk profile, so that which takes care, the portfolio planning process will take care of the short-term fluctuations. Then it is important to do proper asset allocation strategy, which, so that we create a balance between the asset classes. Fundamentally, asset allocation takes care of a lot of short-term volatility. And then very important to monitor the client's portfolio, do portfolio reviews at a regular interval. Keep updating the clients on the short-term changes, market updates, whatever is happening, because I think it's important to be 100% transparent to the client. And then it is very important, the fifth point is how to do scenario planning with the client. It's important to create various simulations of various similar scenarios with the client, which actually helps the client to be prepared for any untoward incident which happens in the market, or any upward downward movement which happens in the market. So when we work in a process format, cover these 5 points, I think it will help the client to strike a fair amount of balance between greed and fear.
Great. So after that answer, my next question is to Mr. Kalpesh. Question is, biases such as overconfidence or herd mentality are common amongst investors. Out of these two, which is more detrimental to the client?
So, hi. I think biases, any kind of biases, are actually detrimental to the client. Overconfidence is definitely one of the most riskier ones. Why I say this is because being here for 23 years, last 15 years predominantly, we've actually not seen a correction. So when even the first question, rapid fire round, when people asked which is the one word that you would want to, the wealth managers to be aware of, it is definitely the fear, and that has not been seen. So as Daniel Kahneman would say, fear is stronger than hope. So there's a fear of missing out. There's an overconfidence that so many 309 companies out of the 500 companies the last 4 years have given more than 100% returns. More than 30 companies have given 1000% returns. So these kind of matrices, when you see, and as ma'am also rightly pointed out, there are stories for every stock. And when you hear those stories, you kind of try and believe yourself. So I feel overconfidence leads you to do more trading, more transactions, less risk assessment. So it's one of the most dangerous one. And plus the fear of missing out makes you, it's a deadly combination to have, which we are seeing in the market. Plus, I feel that, whatever happens in the society and the cultural part of it also, and which I'll cover later on as well. But the point is that also has an impact. Like if you're 10 friends, one of the clients I met last week, he said, I want to change my wealth manager because I got 38% return and my neighbor got about 49% return. So can you better that for me? So the focus has been who is doing better. And I said that, sir, I can't even guarantee you 38%. So I think overconfidence leads to more dangerous decisions, more riskier decisions. And then once you do those, you start losing trust on the market. So one is that aspect. Obviously, the wealth managers can take care of it much better than others in diversifying. What Inder also said, that there is a risk assessment that needs to be done for a client. Diversifying is also something that is very, very crucial for a client. Multi-asset portfolios have given 20% CAGR returns. Nifty has given 15-16% CAGR returns with lesser risk. So multi-assets are better. These are data points that you can share, and like ma'am said, data is more important. So wealth managers, one thing I would want to say is, please go on more data-based decision. Keep the emotions aside. These overconfidence scenario, and once the fear comes in, it will be a very different scenario. So those can be avoided with a proper structured decision making.
Great. So, Srinivas sir, I have a difficult question for you. And the question is, behavioral finance highlights the role of emotional control in investing. How can wealth managers guide clients in managing their emotions during periods of market uncertainty?
I'm the only one representing the AMC world, so pardon me if I don't get the nuances. Pardon me if I don't get the nuances right, but I think the most one thing if you want to do as a wealth manager with your clients to first start off on the right footnote, right, is about there's a study by Locke and Latham, right? These are two people who did some study in 1991 to be precise, where they had 3 pages. The first page was about only 3 points. What's your most important goal? Next important goal, third important goal. And they would actually make their people write that in pencil. So once you establish these 3 goals, the next page was about writing a lot more. Why you want this? Which is your dream vacation? Is it only to do because your peers are doing well or somebody else is doing well? What is it for in this for you? And like 20 other questions which are related to the first 3 questions. And then once you finish this, they made them write the first page again, the same questions. First most important goal, second most important goal, third most important goals. And in most of the times, 92% of the times, the clients will change their answers because the second sheet is the filtration. The first is aspiration, second is filtration, and third is actually the executionable plan that you need. And that sheet, you need to fill them in pen. The first in pencil, the third in pen. If you do that, because what is a portfolio? What is a good portfolio? I think just right now somebody, Kalpesh was mentioning about returns, 49 versus 38%, right? So what is a good portfolio? A good portfolio is nothing but something which helps the client achieve his goal. Period. For that, if you don't know the goals, then you're always gonna flirt around with what's gonna happen. You are either safeguarding yourself or he's accusing and all of that. So I think go back, read about it, Locke and Latham, 1991. Probably it'll help you.
Great, great. Achin sir, there's a question for you. And the question is, in your experience, are there any behavioral traits of investors which can be turned into an advantage rather than a limitation?
Devil's advocate. Huh? So, traits are something which are deeply ingrained. See, competencies you can develop. But traits are something, very difficult to change. And I mean, one of a trait that I can immediately recollect is introvert nature, right? Now, for many of us, I mean, we feel that being introvert, not being socially, very outgoing, it's not a very positive thing. But let's look from the research perspective. Can that be advantage for the people who are, not very socially outgoing? And my personal experience is that that's actually a strength for these people. They think deeply. They are not disturbed by the outside environment. And they do good in that profile per se. So that is one of the things I feel in terms of trade. That we are talking about biases. I'll also take biases. Can biases be good, right? So overconfidence bias, like you said, it's a bad, right? You can't be overconfident. But does it sometimes helps during the volatile environment, right? When the markets are choppy, maybe that overconfidence bias helps you not to take certain decision because you are confident in your investments and you are able to ride that wave more smoothly. So sometimes it turns into advantage during the volatile times. Another probably that you have heard of is the herd mentality, right? Everyone is buying and selling together. Now the same herd mentality created huge wealth after COVID. Now people don't know why the buying happened suddenly, what turned around in March end and buying happened. But because of the herd mentality, people started to invest. Everyone was benefited, and I would say majority of the population benefited from the herd mentality. So yes, I mean, excess of anything is bad, we all know. But sometimes these biases can actually help you when the economy is either going up or down. Problem is you have herd mentality and you don't take decision. When the market is going down, you still have the optimism bias. So that is where the problem comes. But yeah, so that's my take on it.
Great, great. Thank you for that answer. My next question is for Mr. Siddharth. And the question is, with the rise of passive investing and ETFs, there's a growing narrative that individual investors don't need professional guidance. right? And how can wealth management firms position themselves to counter this perception?
Yeah, Deepak ji, thanks for having me here. Congratulations for this great conference which you're having. So, my immediate reply is going to be I disagree. I think we are a country where still the penetration is still so low. Number one. Number two, I think every individual has his or her own needs, and I think someone just mentioned about personalizing one's investments goals, portfolio, etc. So I would say that it's extremely important to be very clear that what kind of advisor you are. And I think when I talk to my advisor friends, I always mention that don't brand or don't do a branding of yourself that I only sell mutual funds, I only do PMS, or I only do stock broking, etc. I think ultimately there's enough of talent available in the BFSI space, especially in the advisory community, where it's extremely important to be a you know a one and all advisor. Uh, because as we're talking about a Viksit Bharat, where in the next 24 years, there's going to be enough of wealth which is going to be getting accumulated. People are going to be earning more and more. There will be a need for advisors. There's, I think, enough space for whether it's passives or active. I think these have to complement each other. And I think the key for the advisor is that, beyond just talking about investment advice, am I doing estate planning? Am I doing retirement planning? Am I doing, intergenerational, where, you pass your wealth to your kids and whoever you've chosen to inherit? I think you have to get into that mode where it's extremely important. I think some of our panelists talked about, I think, these biases. Of course, the role of the advisor comes where, you hit that bad patch. I think the problem is we've only seen, good and great things in the last 3-4 years. I'm not trying to say that there can't be those patches. We've enough seen. I think we've got enough experience in this panel itself where we've seen those times. But I think that's where the advisor is more important. The advisor is very important when you hit that rough patch. One is, I think, when you see the way markets, or if you're assuming you're investing in equity being volatile, but more importantly, when personally also you're going through a phase where you require an advisor. Passives, since you talked about, it's going to grow. There's no two doubts about it. I think globally it's grown. I think in India we started in the last few years where you see passives, index or ETFs growing. They'll continue, but I think that gradually we'll also see a time coming where how to also manage my passives portfolio. It's not only investing in a Nifty 50 or a Nifty Next 50, etc. There's enough of innovations which is happening from the mutual fund industry, for example, on the passive space. So I'll just like to give an example. At times, in the past 3, 4, 5 years back, we talked about polarization, where certain stocks were only doing well in the index. But if you see over the last few years, Nifty equivalent strategy has done very well. But how many people who are aware about that there are passive funds which give you a equated thing? Just one example, and I think that's one category in which we've seen that advisors have been promoting pretty well. So yes, I would say that there's enough space for advisor and will continue to be because of the low penetration which we have and knowledge. And to sum it up, I would say, if you're not good at it, hire an advisor who are good at it. If you can do it for a lawyer, if you can do for a doctor, etc. I think these stories have been on for long. Why should you not have an advisor? Great for you.
I'd like to just add something to this active versus passive framework. And the basic, what an active manager adds is risk management, or should add is risk management. So when you're evaluating also a fund manager, everyone has great stories about how they invest, but do they have an equally well thought out strategy on risk management? And there was an ET Money study, which they were surprised at the result, I was not, which was that the overall best performing funds are those which outperform during downturns. And there was a fund which actually outperformed in the 93% of the uptrend, but it was in the bottom 5 because every time the market fell, it fell more. So the basic thing a fund manager should, active fund manager should add is risk management, because in a mad bull market where every riff-raff stock is running, it is very hard to be higher than that, which is where you come to the 49% expectation that you spoke about. And so that is key, that the day, the COVID crash time, how did you do during the Russia-Ukraine war, for example, during the day the Russia-Ukraine war broke out, Nifty fell 5%, our PMS fell 1.6, because we are oriented towards risk management. That's number one for us. So that should be the focus, and that's the main value add of active management.
Great. So, ma'am, the next question is also to you. Its question is, technology is being increasingly used to understand investor behavior. And I know you've been doing work on data and AI. So, do you use data and AI to get the investor behavior or the mass behavior of investors?
See, the reason you need AI, or we use AI and machine learning, is not because it is available or it is fashionable. The two reasons. One is that basically the market has changed. The playing field has changed. It's like hockey. Hockey, once India used to dominate the world. There were Olympics where India didn't cede a single goal. And 1930s to 70s, you dominated, which is why hockey is your national game. And then something changed. So what changed? The playing field changed. Natural grass ki bajaye astroturf aa gaya, and then therefore what you needed to win that game changed. So something similar has happened to investing. People are still doing things the way they were done 20, 30 years ago, but what is required has changed. Just as on astroturf, that great stick work of Major Dhyan Chand was not required. What was required is how fast you could run, how fit you were. So earlier, the main advantage in our parents' or grandparents' generation was that information was not easily available. Even annual report nahi milti thi company ki, Excel sheet didn't exist. So the main advantage was an information arbitrage, that you knew something which people at large did not know. And I loved that side of securities research. I loved going to plants, meeting companies, going all over the country. So I have been to everywhere from Renukut in UP to, Wadi in Andhra Pradesh. But now the game has changed. Now information is available to everybody. So now it is that who can crunch the information best. So that is where AI ML comes in. But more than that, it is also, we have been speaking about biases, and the question is how to eliminate the biases. And the truth is that you cannot eliminate biases. Daniel Kahneman, who spent a lifetime studying biases, who won a Nobel Prize for it, at the age of 90 said, my decision making has barely changed. I still have the same biases because they are so hard coded. So the only way to get around them is, it's not just biases, it is also random noise. Aap khud hi dekh lijiye, the day you will have a fight either at home in the morning or in the traffic, you will look at the same data differently. I mean, there are 6 of us here. If you give the same data for the same company to all of us, we might all have a different view. So that is noise. So the AI ML system, once you codify your expertise, will eliminate bias and noise and rank companies on the same basis. So that's the purpose, but it is not, I mean, what we use is not a black box. It's doing this work, but we say it's a human plus machine system, because humans are needed to code the machine correctly. Humans are sometimes needed when there is something which is not captured in the data, like a pandemic, or there's something changing on, let's say, the crude pricing or something like that. But broadly, as Daniel Kahneman says, that even a simplified system almost always outperforms even an experienced person, even a judge, whether to give bail or not. It was found that the system worked better than judges with 30 years of experience. You'd be surprised, because of noise, because human beings bring so much randomness into the decision making. And even if you are following not a very elaborate system, of course our system is elaborate, but even if, let's say, you have 5 criteria, that this is the way I will choose a fund, or this is the way I will choose a stock, at least keep to that discipline. Then do not overrule it. Put a risk management, for example, a stop loss system in place, then keep to it. So even if you're using a simpler system, adhere to it, and you will do better than just making arbitrary choices.
Great, ma'am, great. So my next question is to Inderbir. successful investing often requires a long-term perspective. Yet many clients struggle with short-term volatility. So how would you overcome this and help clients focus on their long-term goals?
Okay, so long-term investing is something that all of us are very, very familiar with. I think it's a very broadly used term. Our friends from asset management industry has beautifully educated, I think, a lot of people, a lot of investors that what are the benefits of long-term investing. I'll attempt to put four or five points as a wealth manager. Uh, Again, education. I'm reiterating a lot of points which I covered initially in my first question. Some of them get repeated here, but I'll just try to put the unique ones. Education is very important. Clients should be told that there will be short-term corrections, there will be short-term scenarios, as you approach a long-term goal. So you need to, go through that in a prudent manner, a disciplined manner. And of course, what is long-term investing is also they are supposed to know. So it's not just that long-term investing is something which is basically just staying put into the investment. We have seen scenarios like Lehman crisis, COVID, that when you stay into the markets over a period of long term, they bounce back, they recover money as well. So if you're into right strategies over a period of long term, it's always going to be helpful. Very important for clients to be invested into diversified and resilient portfolios. It's very important that the whole portfolio construct should be diversified and resilient because that's the foundation on which the portfolio runs for a longer period of time. Very important to also, tell the power of compounding. What is a rupee cost averaging? These are very, very good strategies. They sound basic, but trust me, they really, really work very well for a client over a period of long term. I feel that we have to be with the clients, hand holding them. So there's the emotional and there is a very, very, emotional aspect to it where we have to handhold our clients through emotional times. Like some of our panelists said that clients will go through a journey where they will see some things where they haven't seen. A lot of us have not seen maybe a lot of, corrections or maybe, a lot of recessionary phase. So clients also have gone through a journey. We have to ensure that they are updated on time. They are updated on time. They are proactively, made aware of, all these market scenarios. And last is to create a contingency fund. It's very important when we make a portfolio, we create a separate contingency fund for the client. Because when you have a contingency fund created, it helps the client to go through all the long-term volatilities and all the long-term scenarios because they do not have to really make any wrong decision, looking at the market correction.
So I have time for one more question, and this question is open to all. The question is cultural and generational differences significantly shape investor behavior, right? So you might belong to a different culture. Your age, your generation, it impacts how your investor behavior changes. So how do these differences manifest in India, and what has been your experience about it?
I'll take that actually. Especially because Bajaj has been 60-year-old in wealth management and we still have 4,000 plus clients which are 90 years and above. So, and I have a client at the age of 93 who's like, Kalpesh, show me what is the riskiest thing that you've got on your board. I don't want to invest into anything else, And he's 93 and he's very active and he's also making a lot of money, by the way. But yeah, so there has been changes, obviously. I would like to keep it a little light. We can see changes in the Indian market as far as culture is also concerned, generation is concerned, through movies also. You see the movies in the 60s, 70s, the name used to be Roti, Roti Kapda, Makan, Makan. You go to 2000, you will see Dil Chahta Hai, three friends going to Goa. Then, there was a phase of Angry Young Man also prior to that. Then you see in 2011, there are three friends going to Spain for a trip, There is change, a sea of change, of the cultural things that has happened in India. South, not that South didn't had great stars. It always had great stars, Kamal Haasan and Rajnikant and all that. But now the acceptance of South has been very, very high. We saw Pushpa, the first day was 270, the second was even higher. And, I see a lot of people saying Indian markets are like Pushpa, chukega nahi. So you see these kind of trends, coming up. What I want to highlight is that with every generation, and there have been 5 right now, which is obviously the baby boomer, then the generation X, then the millennials, then the generation Z, and now generation Alpha. With every generation, there have been different preferences. Even investment style is very different. And we need to cater to that. We need to find a solution to that. Right now, in fact, one of the reports that came in about last week of 361 clearly emphasized that we used to have a bias that 60 plus guy should probably invest lesser into equities. But that report clearly mentions, and prior to that, a PGIM report came in 2023 that also specified very clearly that 60 plus guys are the most active guys in equity markets. So the trend is changing by every passing day. It's not that they've got all of a sudden a lot of money, but right now their kids are abroad, settled well, earning well. So and they also want to earn more so that they can take care of the expenses that they have. So I feel lots happening in the Indian space. We have seen three generations of change. We will see a lot of millionaires and billionaires coming in the next 8 to 10 years. And how we cater to that as wealth managers is also going to be a tough task. While one of my friends actually addressed the active and passive is also growing quite a bit. But I still feel that at least the next 10 years, active management will be the way forward for the Indian story, at least. There has to be physical touch for our clients to actually understand and more solution oriented than just, give them a product. It should be more knowledge sharing than just about, selling a mutual fund or a AIF or PMS. Ma'am mentioned about Daniel Kahneman. I would also want to mention about a guy that I look up to. There is only one portfolio management theory that has got a Nobel Prize, which is the Harry Markowitz theory. Every wealth manager would be aware of it and would have used it in one of the portfolios or the other. In 1958, 52, he actually had written that paper. It got researched for 38 years and across all the Black Fridays and Mondays and all. And 1990, he was awarded a Nobel Prize, okay, after 38 years of research. 20 years after that, in 2014, when he was asked, what does your portfolio look like? He said 50% equity, 50% debt. So my preference is, although the guy who understands the efficient frontier very well, how to optimize the risk very well, and there could not be a person better than him, would probably choose something which is more comfortable at the age that he is. So these cultural differences also gets, impacted by the age that you are into. Anybody else would want to add?
Yeah, I'll just add one data point and the food for thought for everyone. When India became independent, you could start working at the age of 17, 18 at the matriculation was like the examination, you get some job, right? And that time our average age was about 53, 54. So basically people would start early and post retirement there was not much of time left. Every decade we've added about 5 years to it. Today as we speak, I don't think like you had a certification program, the kids will get inducted not before 23, 24, start working, and they want to retire by 55. So every decade you're losing on the time which is for your working hours, right? In that you have to do something which will sustain longer because our average age is increasing because advancements in medicine. So the job for the wealth manager is actually even more profound now. In that 20, 25 years, 30 years, you have to create something which will last maybe 80, 85. And the second data point I want to put you is every age statistics, if you look at today, and you look at the age distribution in India, above 80, there's only the woman bar which will show up, 80, 90, 100 plus. The men don't show up, which means there are two things. One, women have to plan their finances better. Please help them. And second, the men who also need to provide for their families much longer than they have passed on. Yeah.
Thanks. I'll just one more minute, Deepak. I'll add on to that. So, generational, yes. Cultural, yes. What about gender thing, right? You just brought up women, and I'm a live example. So, my wife, I'll not speak for females, though it may hold true. So, she's a hardcore believer of, gold and fixed deposits. So, and I'm the equity guy. So when I got married, like it took me almost 10 years to convince, you have to actually channelize your money into equities. And it stems again from the risk-taking ability, right? Whether you are, do you have enough knowledge about that or not? But then even in genders, if you see that men are normally prone to take more risk when it comes to female, they are little less riskier. And that's where the awareness and education plays a very critical role. So please again do that, and we have Women's Day coming in Jan, I think, right? So that's the right time that we should definitely educate and make aware. Thank you.
Thank you. Thank you very much. Thank you very much for this wonderful panel. Thank you very much. Thanks a lot.